The innocent mistake that will get your entire retirement seized. This is how a single prohibited transaction inside a retirement account can result in the IRS treating the entire account as distributed on January 1st of the year the mistake was made, triggering income taxes and penalties on everything, even if the transaction seemed minor and the account owner had no idea it was illegal. Most retirement account owners are familiar with the 10% early withdrawal penalty. That is the consequence they worry about. The prohibited transaction rules are in a different category entirely. A prohibited transaction does not just trigger a penalty on the amount involved. It ends the tax-protected status of the entire account for the entire year. Under IRS rules, if an IRA engages in a prohibited transaction at any point during a calendar year, the account is treated as though it distributed all of its assets to the owner on January 1st of that same year. Every dollar in the account becomes taxable income for that year. If the owner is under 59 and a half, the 10% early withdrawal penalty applies to the full amount as well. The account protection built over years or decades of contributions evaporates because of a single transaction the owner may not have even recognized as a problem. The categories of prohibited transactions are defined by the IRS in terms of who is involved, not just what was done. Transactions between an IRA and a disqualified person trigger the prohibition regardless of whether the terms were fair, commercial, or intended to benefit the IRA. Disqualified persons include the IRA owner, their spouse, their parents and grandparents, their children and grandchildren and their spouses, and any entity in which the IRA owner or these family members hold a 50% or greater ownership interest. The IRS defines prohibited transactions as any direct or indirect sale, exchange, or lease of property between the IRA and a disqualified person, lending money or extending credit between the IRA and a disqualified person, providing goods, services, or facilities between the IRA and a disqualified person, transferring IRA assets to a disqualified person for personal use or benefit, and acts of self-dealing by a fiduciary. Real cases show how ordinary-seeming decisions cross into prohibited territory. In Peek v. Commissioner, decided by the tax court, two men used their Roth IRAs to purchase a business. As part of the acquisition financing, both men personally guaranteed the loans used to fund the purchase. They pledged their own homes as collateral. The Roth IRAs owned the business. The business was eventually sold for a combined roughly $3.4 million across both accounts, and the men reported no taxes because the sale proceeds were inside Roth IRAs. The tax court ruled that the personal guarantees were an extension of credit from disqualified persons to the IRAs, a prohibited transaction, because the violation occurred when the accounts were funded with the business stock. The accounts ceased to qualify as Roth IRAs at that point. The gains from the eventual sale were not tax-free. Everything the men believed was sheltered inside their Roth accounts became taxable. In McNulty v. Commissioner, a couple stored $411,000 in gold coins at their home, using an IRA-owned LLC as a legal intermediary, reasoning that personal possession of LLC-owned assets was not the same as personal possession of IRA-owned assets. The tax court disagreed, found the coins to be in the couple's personal possession, treated the entire IRA as distributed, and the couple owed more than $300,000 in taxes and penalties. The IRS does not distinguish between intentional violations and honest mistakes. The prohibited transaction rules apply regardless of whether the account owner understood the restriction, intended to violate it, or received any actual financial benefit from the transaction. There is a correction window of 14 days for administrative errors, where a transaction that was clearly a mistake can be unwound before it triggers the full disqualification. But this window is narrow, requires prompt identification of the problem, and applies only to genuine administrative errors, not to deliberate transactions that turn out to be prohibited. Common situations that constitute prohibited transactions without the owner realizing it include personally repairing or improving property, owned by the IRA and being compensated for that labor, renting IRA-owned property to a family member even at market rate, personally guaranteeing a loan that the IRA takes on, selling personal property to the IRA even at fair market value, and buying from the IRA for personal use. The remedy, once a prohibited transaction has occurred and the window for correction has passed, is to accept the account disqualification, report the entire account balance as income for the year, pay any applicable taxes and penalties, and start over. The rules are not obscure. They are well documented in IRS publications and accessible through any qualified tax or retirement planning professional. The problem is that most account owners in self-directed IRA situations encounter them for the first time only after a mistake has already been made. Knowing the rules before any transaction involving a related party or family member, personal guarantee, or benefit to a disqualified person is the only reliable protection against this outcome. The part that makes the innocent mistake that will get your entire retirement seized so important is that the headline usually sounds simpler than the reality. A retirement account rule can look like a clean yes or no decision from the outside, but inside the account there are layers. Who owns the asset? Where the money came from? How the IRS classifies the transaction? And whether the paperwork matches the economic reality. The people who get hurt are usually not trying to cheat the system. They are usually assuming that a familiar personal finance rule works the same way inside a tax-advantaged account, and that assumption is where the danger begins. A useful way to understand the innocent mistake that will get your entire retirement seized is to separate opportunity from control. The opportunity is the tax advantage, the legal structure, or the extra flexibility the rule creates. The control is what you must give up to keep that advantage intact. Inside retirement accounts, you often gain tax treatment by accepting restrictions on access, timing, ownership, documentation, or personal benefit. When someone focuses only on the upside and ignores the restrictions, the strategy stops being a tool and becomes a trap. The first practical question is always ownership. Who legally owns the money, the asset, the account, or the benefit at the exact moment the transaction happens? In normal life, people think in practical terms. I paid for it, I manage it, therefore it is mine. The retirement account world is different. The account can be the legal owner even when you are the person making decisions. That distinction matters because a tax break is often attached to the account, not to you personally. If the ownership line gets blurred, the IRS can treat the transaction as if the tax shelter was broken. The second practical question is timing. Many tax rules are not just about what you do, but when you do it, a transaction that is harmless in 1 year can be expensive in another. A withdrawal that is clean after a waiting period can be taxable before the waiting period ends. A conversion, contribution, distribution, sale, rollover, or account transfer can all create different outcomes depending on the calendar. This is why dates, tax years, account opening years, and transaction records matter more than most people expect. The third practical question is money flow. Every dollar should have a clean path. Where did it start? Where did it go? And what account touched it along the way? Problems appear when personal money and retirement money cross paths without a clear reason. Problems also appear when income that belongs inside an account is deposited personally, or when an expense that belongs to the account is paid out of pocket. Even when the dollar amount is small, the pattern can signal that the account and the owner are not being treated as separate financial entities. Documentation is not decoration in these strategies. It is the evidence that the transaction happened the way the strategy requires. Statements, custodial forms, plan documents, tax forms, written approvals, purchase agreements, Beneficiary records, conversion confirmations, and distribution records are the paper trail that turns a story into proof. If the records are missing or inconsistent, the taxpayer may still believe they followed the rule, but proving it later becomes much harder. In a dispute, memory is weak, documents are stronger. Consider two investors looking at the innocent mistake that will get your entire retirement seized. The first investor asks only one question: how much money can this save me? The second investor asks a different set of questions. What rule creates the benefit? What would disqualify it? What records prove compliance? And what happens if my situation changes? The first investor may move faster, but the second investor is less likely to create an expensive surprise. Most sophisticated financial planning is not about finding the flashiest move. It is about knowing which details keep the move from backfiring. The emotional trap is urgency. People often hear about a loophole, deadline, exception, account feature, or tax advantage and feel as if they need to act immediately before the chance disappears. Urgency is useful when it motivates research, but dangerous when it replaces research. The right response is to slow the decision down just enough to map the rule. What is allowed? What is prohibited? What is uncertain? What professional should review it? A strategy that cannot survive careful questions is not a strategy worth rushing into. Another overlooked risk is assuming that a platform, custodian, employer, broker, or online form will stop you from making a mistake. Financial institutions are often responsible for processing instructions, not for guaranteeing that the instruction is optimal for your taxes. A button may allow a transfer. A custodian may process a distribution. A plan may permit a contribution. That does not automatically mean the tax result is the one you wanted. The taxpayer is usually the person left explaining the transaction when tax season arrives. The cleanest way to approach the innocent mistake that will get your entire retirement seized is to build a checklist before money moves. Identify the account involved. Identify the rule being used. Identify the tax form that may be created. Identify the deadline or holding period. Identify who is allowed to benefit. Identify what would make the transaction taxable or penalized. Then decide whether the potential benefit is large enough to justify the complexity. This kind of checklist does not make the strategy exciting, but it makes it usable. There is also a difference between legal and practical. Something can be permitted by the tax code and still be a poor fit for a person who does not want administrative complexity. Something can be available inside a retirement account and still be inappropriate if it creates liquidity problems, record-keeping problems, or concentration risk. The best strategy is not the one with the most impressive headline. The best strategy is the one a person can execute correctly, maintain consistently, and explain clearly if anyone asks. The deeper lesson behind the innocent mistake that will get your entire retirement seized is that tax-free or tax-advantaged does not mean rule-free. It means the government is offering a benefit in exchange for staying inside a defined structure. The benefit can be powerful, but the structure is not optional. Once you understand that, the entire subject becomes less mysterious. You stop asking, "Can I get away with this?" You start asking, "What exact conditions make this work, and can I meet them without creating a new problem?" Before making a move, the safest habit is to write down the intended result in plain English. Then compare that intention with the mechanics. If the goal is tax-free growth, does the money actually remain inside the account? If the goal is avoiding a penalty, has the relevant clock actually finished? If the goal is protecting an asset, is the title or beneficiary record correct? If the goal is using a deduction or credit, do the income limits and documentation support it? Clear intention plus clean mechanics is where good planning lives.